Hi, I'm Jared Nelson from the Investing Channel, and welcome to Markets in Minds, the show where we break down big macro themes into simplified trade ideas. Last week saw the end of September and the third quarter of 2021. September was a poor month for equity investors, with the S&P 500 having its worst spell since March 2020. Though perhaps that shouldn't be too much of a surprise because over the last couple of decades, September is, on average, the worst month for equity returns in the calendar. September 2021 even managed to knock September 2020 into second place in the table of poorest monthly returns since the pandemic struck. This table, compiled by NASDAQ, shows stock index total returns until the end of September, the third quarter, the year to date, and prior quarters, as well as the positioning of each index relative to its 52-week high and low. The worst performers last month were technology and growth stocks, with the NASDAQ Composite Index falling by 5.3% and the narrower NASDAQ 100 Index slumping by 5.7%. The Russell 1000 Growth Index fell by 5.6% during September, though it remained 14.3% up over the year to date and 32% above its 52-week low. Over Q3, the NASDAQ 100 and Russell 1000 Growth outperformed less focused indices such as the Russell 2000 and S&P 500. The former fell by 4.4% between June and September, whilst the S&P 500 just about stayed in positive territory, up by 0.6% over that three-month term. Value stocks outperformed growth during September, but that didn't translate into gains. It just meant that value incurred smaller losses than growth. It's also worth pointing out that the majority of the outperformance seen in value stocks came after the Federal Reserve's interest rate and monetary policy meeting on September 23rd. Following which, bond yields and implied interest rates began to rise. That could prove to be a clue about what comes next. So, what might October hold for traders and investors alike? October has a bad reputation as far as stock markets are concerned and is synonymous with market crashes. Indeed, the worst single month in U.S. stock market history was October 1987, but it can also claim the market's best ever month, seen in October 1974. So investors shouldn't read too much into October's poor reputation. Q3 earnings season kicks off in the middle of the month, and how companies report versus estimates and what their outlook is for Q4 and beyond will matter far more than what the stock market almanac says. So, what should we look out for in Q3 earnings? During Q3 2021, Wall Street analysts raised their earnings forecasts according to FactSet data, upping their target for the S&P 500's EPS, or earnings per share, by 2.9% to $48.89. That's unusual behavior because over the past 5 years, or 20 quarters, analysts have typically reduced their earnings forecast by 2.9%. And over the past decade, or 40 quarters, they have cut those numbers by 3.7%. In this chart of quarterly earnings revisions dating back to 2017, we can see that this will be the fifth straight quarter in which Wall Street analysts have anticipated higher earnings among U.S. blue-chip stocks. Those positive earnings revisions have been driven in part by upbeat guidance from S&P 500 companies. 54% of those companies that offered guidance for Q3 2021 issued positive guidance. That's well above the 5-year average of just 39% as recorded by FactSet. The S&P 500 is forecast to deliver year-over-year earnings growth in Q3 of 27.6%, which would put it in the top 3 figures over the last 40 quarters. Revenues are also expected to grow by 14.8%, and if they achieve this, it would represent the second highest quarterly revenue growth since 2008. Sector-wise, materials and energy are expected to lead earnings and revenue growth, with 17 out of the 22 companies in the S&P 500 Energy seeing positive earnings revision by analysts, with Occidental Petroleum's EPS estimate rising from 7 cents per share loss to earnings of 58 cents. ExxonMobil is forecast to earn $1.38, up from $1.13, and Chevron $2.09 per share, up from $1.73. The S&P 500 consumer discretionary sector, on the other hand, is the sector that has seen the largest decreases in earnings estimates among Wall Street analysts. EPS estimates for the sector have been cut by 7.4%. Though, if we dig a bit deeper, we find that just 22 out of the 62 stocks in the sector have seen negative earnings revisions. However, 11 of these have seen cuts of 10% or greater, including stocks such as Las Vegas Sands, Wynn Resorts, and Royal Caribbean. Perhaps the most notable downward earnings revision is that of Amazon, whose EPS forecast has been cut to $8.92 per share from the prior estimate of $12.89. Headline numbers are important in any earnings season, as are beats and misses when they occur. However, perhaps this time round the market reaction to the numbers may be more important still, particularly if we start to see a difference in the way that good and bad news are treated, with, for example, a muted reaction to good news and bad news being punished harshly. That sort of asymmetry would tell us a lot about the mood of the market and the path of least resistance for equity prices in the weeks and months ahead. After all, the higher that expectations are, then the easier it is to disappoint the market. That's all we have time for this week. Make sure you do your own due diligence before making any investment decisions.